Welcome to the Financial Game Plan with Hannah. Hi, everyone. My name is Hannah Versajay. I am your host, and I am super stoked to introduce our guest today. Cody, can you please explain who you are?
Anna, it's great to be here. Thank you for having me on the show. Always a pleasure to connect with you. My name is Cody Laughlin. I'm the managing partner at Blue Oak Capital. We are a Houston-based private equity group that focuses on the acquisitions of commercial real estate across Central Texas. I have a W-2 corporate background in healthcare as a registered nurse, which I started back in 2008, and kind of very similar to most people, most of the listeners on your show. I grew up in a household that put a very big value on formal education. And, I was always told my entire life that I will go to school and I will get a good job and good degree. And I did all those things, right? But it was shortly after starting my W-2 career where I stumbled into real estate by accident, which I'm sure we can get into. But it was through that experience and a couple of other different events all simultaneously happening that I realized that everything I had been taught about building wealth and financial security was actually not going to get me to my financial goals. And so I started on this path of entrepreneurship since, and it's been a fun ride. So
Awesome. Well, I'm super happy you're here. Super exciting. Everyone, I met Cody. Where did I meet you? At MM5, a Jake and Gino
mhm.
conference in Orlando. And they were on stage speaking. And he was like, I'm a Louisiana guy. And I'm like, oh my God, I have to meet him. I ran into you in the little lobby area, took a picture. You were like, "Well, I'm going to a meetup in Louisiana." I was like, I will be there. You went to the meetup. I walked up to you, like, hey, I met you at MM5. And he's like, yeah, you were the only person who said you'll be at my meetup. Met you there. We've kind of kept it going from there. So I'm really excited you're here. I want to start with your accidental landlordship. Tell me how it started because a lot of people do accidentally stumble into real estate, which is hilarious. But how did it start for you?
Yeah, so in 2008, like you said, I'm a native of Louisiana, my wife and I both, and we graduated college and we migrated from Southwest Louisiana to Houston, Texas to start our careers. And in the process of doing that, we also got married, bought a home, started the American dream, right?
Right.
So we bought our starter home 2008, and we moved to a part of the area of Houston where we could afford, not really knowing much about the area. We just said, "Hey, this is our price point. We we'll go with what we can find." 2 years after that, my wife was like, "Hey, we need to get out of this area. We need to go, we need to relocate to a different area of Houston." 2 years in our career, had a little bit more stability. So we bought a second home in a suburban area of Houston with the intent to sell the first home. And the problem was the housing market was still in the dumps. This was still in the wake of the great financial crisis. Real estate was just rock bottom, and we couldn't sell our first home, and we weren't at a position where we could afford to pay two mortgages. So I said, the only option we have is to lease it. And so we hurried up and put a tenant in there and said, okay, we'll figure it out from here. And I had no idea what the heck we were doing, no idea on anything about being a landlord or owning investment real estate. All I knew is somebody's in my house paying my mortgage. I can figure that out. And it wasn't till that year, though, when I went to go file my taxes after 2010 with my CPA, that I really started to have that aha moment. And my CPA returned my tax return and said, "You don't owe any taxes this year." And I was like, "How did that happen?" And he said, "This is what happens when you own investment real estate. When you own investment assets, you get tax depreciation." And I never heard tax depreciation. I didn't know what that was. And that was the start of everything for me. And it was there around that time I read the Purple Bible, as I like to say, Rich Dad, Poor Dad. And it was just, again, light bulb after light bulb after light bulb that was going off. And I got the syndrome. I got the shiny object syndrome, and it was off to the races from there. But that's how I stumbled into it.
I love it. And I love that you brought up the Purple Bible. Everyone who is into real estate at one point or another is going to read Rich Dad Poor Dad. It is a book that I recommend wholeheartedly to anyone, whether they want to do real estate or not. It's a great book about mindset and growth and opening yourself to new possibilities. I remember Brad bought that book. Brad's my husband. I remember he bought that book COVID times. He laid on the couch. He read it in a day. Brad has never read a book in his whole life. And he was like, this is the book that's going to change our life. And here we are a couple years later. And our lives have absolutely changed. Going back to that first investment property, were you terrified? Were you excited? Were you just like, I'm just doing this to survive? Where were you mindset wise when you put that tenant in your home?
I think it was a culmination of all the above, right? I mean, there was some fear, there was some angst. There's a stranger that I don't know living in my property that is still attached to my name. And so of course you have the fears of what if they tear my property up, or what if they, do something crazy to burn my house down or something. So there's all those fears, right? But at the same time, there was some excitement too, because my short-term financial problem was solved. I couldn't pay the mortgage, and here it is, somebody's paying it. I wasn't making any cash flow, but they were at least paying the note. And so that was buying me the time I needed to really figure out what to do from there. So it was a lot of the above. But like I said, when I met with my CPA and really started to get a
Mm-hmm.
realization of, okay, investment real estate has some amazing tax benefits and this is how the wealthy not only make a lot of money, but keep their money. That was the moment where I just dove all in. That was everything for me.
That point that you brought up of it's not really what you make, it's what you keep.
Yes.
I heard that about a year ago. And when I tell you, I thought my head was going to explode. I've never heard anything that made more sense than that statement. You could go make $200,000 at your W 2. Fabulous. But if you're paying taxes to any and every entity out there and you bring home 73,000, well, you're going to live in a very different tax bracket. And with real estate, you have that opportunity to keep more of your money due to those tax advantages. Now, I have another question. You had a single family home there. How did you grow to become the managing partner of Blue At Capital? Because a single family home to this is kind of a big jump. So tell me that story.
Oh man, a lot of stories all combined in that. So we'll kind of condense the time frame, but basically I spent the next, I'd probably say 8 years chasing a bunch of shiny objects. Here, when I started with the single family home, I was in a position that most people are when they start real estate. I didn't have any liquidity. I had very little capital. I had no experience. And so I needed to find a way to build capital in a quick way versus going to work 80 hours in the hospital, right?
Right.
So one of the strategies I started looking at was real estate wholesale. Okay. And so I did wholesale for half a minute. And then I realized like this sucks. I'm sending out flyers, I'm sending out China direct mailers. And at the time, yeah, the internet obviously was around in 2010, but I don't think like direct mail marketing online was as prevalent as it is today. So it was a lot of paper mailing and stuff, which was very cost prohibitive. And then
Mm-hmm.
it was time intensive. And then, I just didn't find there to be a light at the end of the tunnel. And so I was looking at other strategies with tax liens and, subject to type acquisitions and such. And so I basically was getting to this point where I was trying to pursue all these different strategies, but I wasn't just staying heads down focused on one. And I kept trying to bounce into the next thing and the next thing and the next thing. And then in addition to that, was trying some other non-real estate business ventures. I tried the multi-level marketing companies. I tried selling some products, which was terrible. I wasn't a salesman, never had done any sales position in my life, and so I just really was not finding any real type of way to scale a profitable strategy, so to speak. And 2015, I fast forward, I was like, I had this bright idea. I was like, hey, I want to buy a franchise. I was kind of slowly accumulating some capital and putting aside, but I was like, I want to go partner with some people and go buy a franchise. And I'm really big into fitness. I love health and fitness. I used to live in the gym all the time. And so I was like, hey, I'm going to go buy a fitness franchise. And I'll make that short and sweet. 3 years fast forward, I burned $150,000, didn't get a single unit open, and was out of partners and lost everything I had put into that, both time and money. And it was after that experience where my wife, God bless her, love her to death, she sat me down and she's like, you really need to get focused. Like, you need to figure out what you want to do in life and stick with it. Quit bouncing around doing all these things. And the one thing I kept coming back to was real estate. And so that was where I made the decision to, again, keep focused on real estate, and this time remove all the other distractions from my focus, and I just put heads down and got committed to that. I got into single family flips, lost some money on flips. Um,
Flips
it,
flips are
yeah,
I mean, that's gambling, so it's
it,
tough.
it's gambling. It's absolute
Hmm.
speculation, and there's so many different factors that working against you. But it's also a second job. I was after every shift, I was having to go check on the property, check on the contractors, make sure that things were moving along. Right, I was there on the weekends. I was doing some of the work myself just to save money. Right, and all these mistakes that people have made, and I'm like, I'm working to a second job, and all to see really no profit out of that. So that was really the catalyst to get me to think about, how do I scale this, and how do I scale this for not only the short term but the long term. That's where I was led to multifamily, right? And so when I got introduced to multifamily, I just, the model made sense. I can partner with other people. I can pull together resources. And instead of going to buy one single family house, now I can go buy 10 or 100 units in one transaction and really be a benefit, or have the benefit of the economies of scale. And I made that pivot in 2019 and never looked back. And, met my first partner, John, through a networking event, through a mutual connection. And we had a great synergy, a great alignment of interest. We started working together, as we like to joke and say, we started dating.
Yep.
And then once we realized, like, hey, this is a good relationship that we can really build a foundation on, we started Blue Oak Capital, and we met our third partner, Brian, who, you met with us over
Hmm.
in Orlando and Louisiana. And Brian was with us for a couple of years, and he recently left the company, but we had a lot of success with bringing him onto our team. But here we are today. Fast forward, since 2019, we've acquired through general partnerships, 5 multifamily properties, 2 industrial. So we have about 950 multifamily units across 5 acquisitions, and then a couple 100,000 square feet of industrial space. And we've raised millions of dollars to do that. And it's been a night and day difference from what I was doing the 8 years prior. So
That is amazing. When I say that you should be proud of yourself, and I'm sure that you are, but what you have done is exceptional. Like looking back, just the past couple of years, going from those single flips to now, that's sensational. Like, congratulations. I'm really happy for you. So, question: when you are looking for these acquisitions, whether it be multifamily or industrial, if that one just kind of happened, what are you looking for? Like, what is your criteria? What is your buybacks? What is your, like, hey, I'm not buying down this street because it's just crime, crime, crime. What are you looking for?
So it's kind of a loaded question, right? Because it's a very
Yeah.
broad question. But to kind of narrow it down and answer your question more specifically, let me give you some context. When I got into multifamily, I was drawn in by this idea of value add, right? That's one thing that we love about multifamily compared to single family, is I can control or impact the value, which ultimately impacts the purchase price or the long-term value of the property, right? So, like most people, when they get into multifamily, they hear about the value add strategy. I go in, I buy a distressed property, I make improvements, and then I turn around and I either refinance or to sell it at a higher price and make a profit. And so that's how we got started. We started with value add multifamily, here in Houston, in an out of state market, with some strong operators that had experience. And then the market turned, right? And well, I'm sorry, the market didn't turn at that point. We had a lot of momentum. We started gaining momentum. We did a few more acquisitions, and then last year is when the market started to turn, right? And then up until that point, we had acquired a couple of workforce housing deals, so value add deals. We also acquired a couple of newer A class buildings, right, that appealed to a kind of more affluent demographic, higher income status, in better locations. And then the market turned last year. And what we realized in going through kind of this rolling recession, this market recession that we're in, our C class value add properties tend to be hit the most, or have the most sensitivity to the current environment, right? Growth from inflation and cost of living and all these different expenses. And then on our end, on our properties, I'm getting impacted by taxes and insurance and higher operating costs that have to eventually translate through to the residents. I have to increase the rents to make up that difference. But on my value add C class properties, my workforce housing demographic, I have a hard time doing that because their income is capped, right? So I can only push rent so far and so hard in that demographic, less so than I can on my more affluent demographic that's renting out our A-class properties. So that was kind of a new light bulb moment for us over the last 24 months, is just really seeing the difference in operations and elasticity across, class A, class B product versus value add. So to answer your question more directly now, what is our buy box? We are typically looking for newer, higher quality properties in higher affluent demographic areas, right? So we're looking for, properties that are older than or newer than 1990s, early 2000s, that do have some upside potential. Maybe I can go in and make some slight cosmetic improvements to bring it to today's current market standard. Maybe we can repurpose, some of the residents and bring in some better management. But ultimately, I have a higher quality product that doesn't have all the old deferred maintenance, old electrical circuits, old plumbing issues, and things like that. That I don't have to worry about those things as much as night. And I have a resident that can afford to pay, $1,300, $1,400, $1,600 in rent even across some of our units and such. And so that's kind of our buy box. We love newer product in great locations. I've learned this the hard way as well. Everybody, when they first get started in multifamily, you typically think of what your own resources are, and that drives your investment decision. So a lot of people start out with small multifamily. Hey, I'm only going to do a duplex or fourplex or 10plex. Well, the smallest deal we have in our portfolio is a 60 unit. I can tell you operationally, it's the biggest challenge we have, because again, our income is capped as much as we can push. We don't have any amenities on our community, so I can't charge a certain premium without those community amenities. And there's just other operational restrictions that come along with a smaller property. So we like properties that are 100 units and bigger. Our largest property is a 396 unit, and that thing's got a full team of 6, 7, 8 staff members on there that handle every aspect of the operations. So it makes our job a lot easier as the asset managers and owners of that property. So newer buildings, high quality buildings, better locations, and larger buildings, 100 plus units. So
I never thought about a smaller unit being more challenging because of that. My complex is a smaller complex compared to what you have, and it is very challenging because, again, my workforce, like you said, they're capped. I can't do a whole lot because they're tapped out. Very interesting. You brought up management. Tell me about property management, your history with them. How does it go? I know everybody either loves them or hates them. You kind of have to have them when you have this many complexes. So tell me about your management experience.
yeah, look, I mean, there is a negative stigma when it comes to third party property managers. You hear a lot of horror stories, and you hear a lot of owners that have a lot of angst when it comes to working with third party property managers. And they're rightfully so, right? I mean, when you have a property management team that's its own independent company, what you have to understand about property managers is, number one, they have one objective, right? Well, I say two objectives. It's occupancy and collections. Like, that's their two biggest objectives, right? Is to make sure that they keep cash flow coming in. And the rest of it, they may not be the best experts at, right? Typically, property management companies are not going to be the best experts when it comes to things like managing a construction plan or, different other things like marketing, for example. But their job is just to manage the residents and keep rent payments coming in, right? That's their ultimate job. The problem that property management companies face is they're not a highly profitable business, right? The margins on a property management company are so limited that it impedes the ability of property managers to really hire good, high quality staff or be able to provide a level of service that meets your needs as an owner. So I put that into context because that's a lot of the distress that or bifurcation that you see between owners and property management companies. Now, what you have to consider, though, when you talk about property management, is you can be vertically integrated, which means you can do your property management yourself. And there's a lot of pros to that. You have full control. You have no middlemen. You have no fees, hidden fees that you can't see. You're in full control of the property, which means that you can make any change at a dime and go and execute your property. But what you have to realize is, when it comes to going vertical, you have your acquisition business, which is the process of buying the real estate. But now you have a second business, which is actually starting a property management company. And they both run independently. So now you have two businesses, not just one that you're trying to start. And if you know anything about starting up a business, startups are hard, right? Even on the acquisition side, it takes a while to gain momentum and scale. So to take on two independent companies, which have to be ran as such, it can be very, very challenging for people. So it kind of stipends people's growth, especially when they're first getting started. So I've had some negative experiences with third-party property managers. We're actually in the process of evaluating replacing one of our property management teams now on one of our properties just for lack of performance. But I've had other great experiences. I've got property management on all of our other properties, and they're doing great. So it's one of those things where you have to vet your property managers very diligently. You have to be a very hands-on asset manager. You have to have very well-defined key performance indicators and metrics to hold them accountable to, and you have to be able to make quick decisions. If they're not performing and they're not able to achieve your business plan as you set out, then you have to make a change. You have to be able to step in and do that. So long-winded answered your question. I'm sorry, but look, I think anybody just getting started, I highly recommend to anybody, work with a third-party property manager. They're going to know things that you don't. You're going to be able to learn a lot of things, both good and bad, about property management, and then give yourself time to scale. I had a mentor many, many years ago tell me this, that your first 1,000 units, you really want to be working with a third-party property manager. Learn by working with those guys. And then once you reach 1,000 units, you typically have that economies of scale that allow you to be able to take in that and bring in that property management house. And then now you have resources and you have the education behind it to go out and take that endeavor on. And so that's kind of how we've operated under.
You said that you were in the 900 units. Is that correct?
950.
So you're getting close to that 1,000 units. So is that a natural progression in your business plan, is to open up your own property management company? Or do you want to go past that? If that's what your mentor has suggested, where are you in that?
Yeah, it's an interesting question because I go back and forth, right? I think there's moments of time where I'm like, yes, I wish I could have our own property management team in house and that we were controlling every aspect of the business plan or the management. But then there's other moments of time where I'm like, if I had to worry about the day-to-day operations of a property management team, I wouldn't be able to go and do what I love doing, which is looking at the next deal and looking at other properties and things like that. So I don't know. It's a tough question. I think eventually down the road, yes, I would like to bring property management house and go fully vertical, but I don't know if I'm going to be there yet. I think we still have some time because I still want to continue to grow and not slow down.
What is your eventual goal? What do you want? Do you want, I hate to put a number on like 10,000 units, but do you want to dominate a city? Do you want something in 25 places? What is kind of your ultimate goal?
I want $1 billion business. I want to reach the level of scale where we have $1 billion under management in our portfolio. And the reason why I think $1 billion resonates with me, because once you reach that level of scale, once you have that many assets under management, you have a fully integrated team that allows you to scale and allows you to sustain over the long term, right? Now, this is no longer a hobby. This is no longer just a side hustle. When you have $1 billion under management, you have a elastic business. And that's my goal, right? Is to create this business that not only I can operate for 30, 40 years down the road, but also have something that my kids can participate in and be a part of as well. And my business partner shares the same vision as well for his kids. So, it's building, we talk about generational wealth, right? Being able to give our kids something that they can then take over and continue and sustain, hopefully. And that's not just talking about the real estate, but a functioning business that's here for the long term.
Are your children interested in real estate? Is this
No,
something they would like to do?
I've got kids that are all at different ages, and they all have their different interests right now. I think my youngest, my 4-year-old, has that CEO mentality there. So I think she might be the one that I'm gonna have to keep an eye on. But
That's wonderful. Caroline loves real estate. She just turned 5 this summer, and we have at our complex, we have a coin operated laundry. The first of the month, she knows on the calendar, she has it written down that she gets to go wash the machines, wipe them down. She cleans the baseboards and she sweeps. She also pulls out the coins with her daddy. And if she does that, she gets to go bowling. This girl can run the world one day. I have full faith that she can do this. I hope that she just runs us all over.
Well, let's talk about this real quick. And I don't know, forgive me, we'll digress a little bit here,
No,
but
what's up?
for anybody that's listening, that's a really powerful statement. And kudos for you, number one, for doing that. I take my daughters on my property to go on the asset management tours and such, and they don't like it. But look, when I talk about generational wealth, I don't talk about just handing down real estate or a business. I also talk
Correct.
about handing down the principles and education that you need to change your financial future, right? It's not, hey, you don't have to go to school and get a formal education to be successful. You can be an entrepreneur and you can take control of your own financial destiny, but it starts with teaching them young, right? You're teaching these principles now of, hey, we get to go collect money from people that pay to live in our buildings. Like, and guess what? Now that affords you the opportunity to go live the lifestyle that you want to live. That to me is every bit a part of generational wealth, that we can pass down to our children. But not only that, but think about like the tax incentives that you guys get to do. You can now pay your daughter a salary of up to $14,000 per year, completely tax-free. That's a business write-off. So you get a business write-off for your business. Your kid makes a salary completely tax-free that now you can then use for, education savings fund or whatever savings funds you want over the long term. So just some things like that are just ways that we can all benefit. We can impact our families, our kids in a way when we talk about real estate, when we run it like a business. So anyway, I just thought, again, kudos to you and good job for doing that. And for anybody listening, you should be doing the same. So
Real estate is powerful. And like I always, always say this, but I genuinely believe that anyone can do this. People need to just suck it up. Everything is free on YouTube. You can learn how to do real estate for free. Now, does it make sense to go to conferences and meetups and learn and pay for coaches? Absolutely. If you want to grow, I am trying to grow my empire, but everything is out there and people can do this. And I'm starting with Caroline because I want her to have the option. My big word is option. Everyone says, why are you doing this? Financial freedom is what most people say. That's not my word. My word is options because I want the option to go to work or the option to go to France on a Tuesday to get a baguette because I want a sandwich. I want options. And I think that starting with Caroline really young and making her work, she's 5. She loves to help, but she will continue to do this or different aspects of the business until she's old enough to really understand. Because for her, pulling the quarters out of the machine is hella better than getting a check for $1,000 because she
absolutely.
she doesn't understand. But anyways, when you are looking at areas and areas for growth, what are you studying? Are you studying trend reports? Are you studying jobs coming in and out? Are you studying like roads being built? What are you doing to figure out where to invest your money?
So what we do is when we look at a market, now, number one, let me just preface this by saying I'm very blessed now to be in Houston, Texas, which is a, 5th largest city in the country. So we have a huge metroplex here. So a lot of investment opportunities. I know not everybody listening may be in the same situation. And I know you and I have talked about this offline about investing back where we're from and all these things like
Yep.
that. So I digress. But when we look at what markets we find suitable for investment opportunities, we look at both the macroeconomic landscape and the demographics, right? I want to be in an area or a region that is bringing in both population and jobs, right? And these two go hand in hand. Where there's job growth, there's going to be people. All right. And so when there's people, that means there's going to be housing needs. And that's the problem that we can solve. So I want to make sure that I'm investing in an area that's attractive to employers, right? Companies that are headquartered or bringing arms of their companies into a particular region, bringing in jobs and population, and then also wage inflation. Wage growth. I want to see economies that are supportive of increasing wages over time, right? And so when you have a service or product that's in demand, that means that people are going to be earning more. They're going to be making more, right? And so that means they can afford more. And so those are the things that I look at from a macroeconomic scale is the local economy, job growth, population growth, and the type of business sectors too. I think this is important. You never want to be isolated into one market that has only one economic driver, right? And if you go back to my home town of Lake Charles, Louisiana, right? It's the refineries or casinos. That's it, right? So you either, most of the population is employed by those two type of sectors. So, if one of those crashes, the whole economy shuts down. So luckily in like Houston, for example, you have a variety of different sectors and no one industry makes up the majority of all the jobs that are held. So we look for job diversity as well. And then I want to look at the demographics. Again, we talked about this, right? But I want to look at a demographic that has a higher than average, both local and national median income, right? So if my household median income in Houston is only 45,000, I want to look for the demographics that have a, median income of 60, 70,000 or higher, right? So that means they're typically better well off, excuse me. They have probably better paying jobs, and they have more elasticity to weather certain market downturns. And so I know we talked about this earlier, right? My one of my C-class properties is in an area that has about a $40,000 median income, and it's a struggle. It's a struggle for that demographic to really make it through the economic times that we're in now. So those are just some things at a high level that we look at, and then we get all the way down specifically to the census tract, the zip code, and drill down on those same drivers even more specifically to a general region. So we have two primary markets, Houston, San Antonio, and we have very well-defined regions and where we will and where we will not invest in those markets. So
I love San Antonio. I love Houston. We go all the time. I keep trying to get Brad to move out there. Haven't pushed him just yet. We're getting close. Earlier you spoke about mentorships, and that's how you found your partners. How important are mentorships to you?
It's crucial. And look, if before you do anything else in this space, anybody looking to get started, the very first investment you absolutely should make is in a mentorship program, right? Don't go buy a piece of real estate. Don't go do anything. Invest in your own education and invest in yourself. The way you can do that is by mentorship programs. And I'll tell you, the biggest benefits that you will get out of a mentorship program is it will accelerate your timeline, both from an education perspective, a systems, a network. You get access to a network. And so all of those components will accelerate your timeline of success. But the second biggest and probably even more impactful thing that you will get out of a mentorship program is they will help save you from making costly mistakes. I told you my story. I've made a $150,000 mistake trying to buy a fitness franchise. I've lost about another $50,000 on single family flips, so $200,000 combined. It took me years to recover from those two insults, right? If I had mentors going into that without just flying off the seat of my pants, they could have saved me from making some of those crucial mistakes. And that in itself is an infinite return on your investment.
How did you pick your mentorships? I have been looking at, it feels like hundreds of them. I know you and I have spoken about this offline. How did you pick the one that fit you?
So it really comes down to your core values and your long-term financial plan. And then when you really have that defined and you know exactly what you're trying to achieve and then what you believe in at your core, then it just becomes a matter of trying to find the different groups that really resonates with that same value, right? So like I'm a father, I'm a husband, I have a part-time W-2 career, and things like that. So juggling both entrepreneurship, working and being a present father at home and a husband at home, it's a lot to juggle, right? And so like our first mentorship with the Wheelbarrow Profits Academy and hosted by Jake and Gino, one thing that really drew us into those is the family community. It wasn't just about business. It wasn't just about buying real estate. It was about, hey, how do you be a family man while you're trying to juggle being a businessman and being a W-2 employee? How do you be present for your kids? How do you talk about, building generational wealth, and teaching your kids that? So it was just the whole family dynamic behind their teaching and their philosophy that really hit home for me, because that's everybody's struggle. That's everyday struggles, right? And so I wanted to be a part of a community that believed in and is going through what I'm going through and kind of can help teach how to manage all of those different things. And so So it's, again, it just really comes down to what your core beliefs are and what's your financial plan, and just finding the ones that really align to you. And look, there's 1,000 of them out there. I mean, there's so many different mentorship programs out there, and look, most of them are all really good, right? You talk to a million different people, you'll probably get a million different answers on which one you should go with. And I think you and I have talked about this offline, right?
We
I think
have, yes.
it's really important to find that program that really resonates with your investing strategy as well, right? If you're looking to do single family and that's all you want to do, great, go find your mentorship program that really focuses on that. If you want to do, large multifamily syndications, great, there's programs for that, right? So just, you gotta be able to find the ones that really resonate with who you are, both as a person and as an investor. So
That's amazing. I'm really struggling to find that. Again, you and I have talked about this many, many times. I'm sure we're going to talk about that when this podcast is over. But that's the next step for us, is finding that person or a group of people that really just make us click. I am willing to spend the money and do the work to grow my empire. Question. You mentioned the word syndications. Can you tell me what syndication means for our listeners who do not know?
syndication is just a fancy term to say, hey, we're pulling together resources to go buy an investment asset, right? In this case, real estate. So I pull together a team of partners, and I pull together a team of passive investors. And together we pull our resources together and we go buy a piece of real estate, and we all have ownership in the deal. That's all syndication is at its core. It's very, it's simple when you break it down that way, right? But uh,
Absolutely.
basically, it's like playing a football game. I love football. It's one, or baseball. Yeah, I love baseball too, right? It's a team sport. All of us work together as one single unit with multiple players to go buy real estate.
How do you get the courage to ask people for money? Because you're not doing single family homes. You're looking at millions of dollars. So how do you pick up the phone like, hey, George, can I have $3 million? I mean, how do you do that?
Well, I think, look, when you're just getting started and you're thinking about the idea of raising money from other investors, that's the kind of innate question people ask themselves. Well, what do you mean I got to call Hannah and ask her for $50,000? What you have to understand when it comes to raising capital from other investors is, I'm not looking to go collect $50,000 from you. I'm looking to go figure out what your financial problem is and how can I solve it with real estate. So if you're a doctor and you have a high income and you have a heavy tax burden because you're in a certain tax bracket, that's very frustrating. Great. I have a piece of real estate that can offer you major tax deductions that will bring your taxable liability down, right? If you want to be a part of that, great. It's going to be a $50,000 or $100,000 investment, but you have to, but this fixes your problem, right? So when you make that mindset shift of trying to instead of trying to figure out like, okay, who has $50,000? It's like, no, who has a problem and how can I solve their problem? And then when you make that transition and you really start offering investment opportunities to people that know you, like you, and trust you, and you're solving their problems, you'd be surprised how much money is out there and that'll flow to you.
Dude, like mind blown. Because when I went to my partner for the complex we bought and was like, hey, I'd like to do this, but I need 100 grand. I have the rest. It worked out great. We bought it. But if I could have been like, hey, I know you are a super high earner, you have a tax bill issue. Let's work together. I feel like it would have been so much easier, and I would have maybe gotten back a little bit of sleep that I lost because I was so very nervous. So, are you ready for the final questions?
Let's do it.
Okay, so my final questions are a little bit different than everybody else's. I feel like most podcasters are so serious. What's your quote? What's your book? A little bit more personal. Okay, first one. Think about your bucket list. What
Mm-hmm.
is something on your bucket list that you want to accomplish within a year?
Oh, within a year. Holy smokes.
Yes.
Oh, man. I want to visit all 7 continents.
Okay, very good. I love to travel, so I totally feel you in that one. Second one. What is a skill that you've always wanted to learn?
Woodworking. I love people that can, just get a couple pieces of wood together and just create this beautiful piece of furniture or wood art or whatever. And I like working with my hands too. So I would love to learn the skill of woodworking.
Yeah, I'm not so good with hammer and nails, which is I wish I were. My dad, who passed many years ago, built our dining room table, and it's an 8-seater. My mom still has it. we used to have this tiny little four top table, and Thanksgiving was happening. My mom was freaking out. People were coming over, and he just, in like 2 days, built this giant table. And mad skills, but I don't have it. Okay, your last question. If you could go back in time and talk to your 18-year-old self, what piece of advice would you tell yourself?
Skip college, invest in an entrepreneurship mastermind or mentorship program. I would go find the most successful people in the avenue that is what I want to pursue. And I would go work for them for a few years, learn as much as I can. And then I would start my own journey from there.
Fabulous answer. Fabulous answer. Okay, Cody, I loved your answers. How can people get in touch with you?
All right, Hannah. Well, to return the favor, if anybody's listening, I want you to go on your most favorite streaming services, podcast, Spotify, Apple, whatever it is. Leave Hannah a rating and review for her show. Take a screenshot of that and text it to 832-743-1400. You'll be able to connect with me directly. I'll schedule a free consultation call with you and see how we can help you get started.
You are too awesome. I appreciate it. I'm going to put all your contact info in the show notes. Cody, thank you so much. I appreciate your time so much.
My pleasure, Hannah. Thanks for having me.
If you enjoy this podcast, please like, follow, subscribe, and leave me a 5-star review. I would love to continue doing this. And you guys giving me that positive feedback really makes my heart happy and lets me continue to do what I enjoy. Thanks so much, guys. I hope you have a great day. Bye-bye.